Hey, welcome to The Explainer. This is where we take a look at really complex stories and untangle them using the data and the research behind it all.
All right, let's just jump right in because here's the thing. Markets are hitting these incredible highs, right? So why does it feel like everyone is walking on eggshells? I mean, on the surface, everything looks fantastic. Wall Street just finished a 4-month winning streak, but if you scratch beneath that surface, you find a market that's starting September, well, pretty nervously. And that contradiction, that's the mystery we're going to solve today.
It's like the market has a split personality right now. There are these two huge, opposing forces just pulling investors in completely different directions. On one side, you've got all this short-term worry. There's the whole September effect, that historical trend where markets just tend to get a little weak. Plus, you've got inflation that just won't quit, bond yields creeping up, and all this geopolitical uncertainty kind of looming over everything. But then on the other side, if you look further out, wow, there's a ton of optimism. We're talking strong corporate earnings, this promise of a massive productivity boom from the whole AI revolution, and this growing hope that the Federal Reserve is finally going to start cutting interest rates.
So let's dig into that. This is what we're calling the global markets paradox.
Yeah, it's a really unique moment we're in. We've got all this anxiety, all this volatility bubbling up, even while a lot of markets are just hovering near record highs. This isn't just a vibe, it's a real structural paradox playing out in real time, all across the world. Investors are literally trying to balance this fear of what might go wrong in the next few months against the excitement for what could go right in the years to come. And that balancing act, well, that's where all the choppiness comes from.
Okay, so to really get to the bottom of this mystery, our investigation has to start with the single biggest player in the game, the United States Federal Reserve. I mean, its shadow is it's massive. It stretches over every single market on the entire planet. And look, if you want to understand the Fed, you have to know what they're looking at. And while everyone's talking about the CPI, the Fed's preferred inflation number is actually something called PCE. Why? Well, because it captures a much broader range of what people are actually spending their money on. So in their eyes, it's a much more accurate picture of what's happening with prices in the real world. And believe me, the Fed's decisions don't just stay within U.S. borders. I mean, what the Fed is even expected to do has become the #1 thing moving markets as far away as Japan. Seriously. From Tokyo to Seoul, traders are placing bets based on what they think U.S. monetary policy is going to do next. Everything else is secondary.
So, all eyes are on the next big clue, right? And that comes this Friday with the U.S. jobs report. This is a huge one. It's a make or break number that could totally set the tone for the rest of the month. And get this, economists are forecasting a really low number, just 75,000 jobs added in August. Now you might think that's bad, but here's the twist. A weak number like that actually strengthens the argument that the Fed will have to cut interest rates in September to prop up a cooling job market. And that, in a nutshell, is the optimistic view right now. Bad news for the economy is actually good news for the market. It's kind of wild, right?
Okay, but while the stock market is over here cheering for these short-term rate cuts, there's a rebellion brewing in a totally different part of the financial system. And it's a part that has the power to just completely shut down all that optimism.
Yeah, this rebellion is being led by a group they call the bond vigilantes. It's a great name, right? It's basically investors who push back against government spending policies they don't like by selling off long-term government bonds. And when they do that, they can actually force borrowing costs to go higher, no matter what the central bank is trying to do. And you can see their impact everywhere. We're talking globally. In the US and the UK, long-term borrowing costs are spiking. For the UK, 30-year yields just hit their highest level since 1998. That's a long time. These vigilantes, they're worried about government stretching their budgets too thin, about inflation sticking around, and so they're demanding to be paid more to lend money for that long.
And this brings us right back to the other side of our market paradox. See, when these long-term yields go up, it puts a ton of pressure on stock prices, especially those high-growth tech stocks. It's like a powerful headwind, blowing directly against that tailwind of hope for short-term rate cuts. But this whole ripple effect gets even more fascinating, because it turns out it's not just about if U.S. rates go up or down. Research from the World Bank shows that the reason why they move is actually what's most important for the rest of the world.
So, the World Bank basically says any U.S. rate hike happens for one of 3 reasons. First, real activity. That just means the U.S. economy is genuinely strong and booming. Second, inflation developments. Pretty straightforward. Prices are just stubbornly high. Or third, Fed reaction shocks. This is when the Fed suddenly gets way more aggressive than anyone expected.
And depending on which of those three it is, the outcome for other countries changes dramatically. For example, when U.S. rates go up because the American economy is on fire, that's actually a good thing for developing economies in East Asia. It means healthy global demand, more exports for them. But if rates are rising to fight inflation, or because of a surprise Fed move, that really hurts them. It slams the brakes on their GDP growth and tightens up financial conditions. So how is this massive ripple effect even possible? Well, it's because structurally, you can't think of the global market as a bunch of separate little ponds. It's not. It's one giant, single, deeply interconnected web. And I'm not just speaking metaphorically here. Researchers have literally mapped this out. What they've found is that the global stock market acts as one single integrated system. And right at the center of that system, the main cluster, is the US market. So shocks that start in the US, they don't just ripple out slowly. They travel instantly through all these built-in connections.
And inside this giant web, you have what you could call superconnectors. These are certain industrial sectors that act as the main hubs, transmitting financial feeling and sentiment across the entire system. And the research points to three big ones: financials, energy, and materials. Think of them as the main arteries for how the global market moves together.
All right, so we followed all the invisible threads, right? From Fed policy to these bond vigilantes, all the way to the very structure of the global market itself. And now, I think we can finally solve the mystery of why the market feels so strange and so anxious right now.
It really all boils down to this: the market's paradox, this anxiety. It all comes from how deeply interconnected everything is, with the US Fed basically sitting in the driver's seat. And right now, we're watching this epic tug-of-war. On one side, you have the hope for short-term rate cuts. On the other, you have the fear of long-term government debt problems. And that forces every single investor into this incredibly delicate balancing act, like they're walking on a tightrope between being cautious and being optimistic.
And that leaves us with one last big question to chew on. In a world this connected, where a jobs report in America can send the Tokyo market soaring or sinking, where bond investors in London can change the value of a tech company in Silicon Valley, is the very idea of a truly local market just an illusion? Something to think about the next time you check your portfolio.